In the chronicles of any great human endeavor, there exist figures of such profound genius and tragic complexity that their lives transcend mere biography and become parable. In art, we have Van Gogh, a man who could paint the divine light of the stars but could not escape his own inner darkness. In science, we have figures like Tesla, whose minds could illuminate the entire world but who died in obscurity. These are the Icarus figures, the rare individuals who fly closer to the sun than any other, showing us the very limits of human potential and, in their inevitable fall, revealing the immutable laws of nature, whether physical or psychological. In the unforgiving world of the financial markets, that figure is, without question, Jesse Livermore. His is a name that echoes through the history of Wall Street with a unique and powerful resonance, a name that is spoken with a mixture of reverence, awe, and sober warning. He was the boy plunger, the young prodigy who mastered the speculative game in his teens. He became the great bear of Wall Street, the financial titan who bent the markets to his will, accumulating a fortune of $100 million from the ashes of the 1929 crash, a sum equivalent to well over $1.5 billion today. More than any speculator before or since, Livermore seemed to have solved the great puzzle of the market. He was a master tape reader, a brilliant psychologist of crowd behavior, and a financial strategist of unparalleled genius. The rules and philosophies he developed, immortalized in the legendary book Reminiscences of a Stock Operator, have become the foundational text for generations of traders. They are the distilled wisdom of a lifetime spent in the crucible of the world's most intense financial arena. A link to this book has been provided for you in the description below. And yet, this is only half of the story. For every legendary success, there is a catastrophic failure. For every rule of discipline he preached, there is a chapter in his life defined by its spectacular violation. This is the man who made $100 million in 1929, only to declare bankruptcy just 5 years later. This is the man who taught the world the supreme importance of cutting losses, yet repeatedly held onto losing positions until they destroyed him. This is the man who warned against the poison of hope and fear, yet ultimately succumbed to the deepest human despair. His life, which began with a $5 stake and soared to unimaginable heights, ended in tragedy and suicide, with liabilities that far exceeded his assets. This is the great and terrible paradox of Jesse Livermore. He was the man who cracked the code of the market, but he could never fully crack the code of his own human nature. He was the master architect of a flawless system for speculation, and yet he was its most tragic victim. His life story is not merely a chronicle of wins and losses. It is the ultimate case study in the psychology of risk, the intoxicating allure of success, and the destructive power of an undisciplined mind. This brings us to the central question that we will seek to answer in this deep analytical dive. It is a question that goes to the very heart of what it means to operate in the financial markets. How could the man who formulated the most brilliant and timeless rules of trading so consistently and catastrophically break them? What were the forces, both in the market and within himself, that led to this profound disconnect between his genius-level knowledge and his real-world actions? And most importantly, what does his epic, tragic journey teach us about the fundamental nature of the market, the inescapable pitfalls of human psychology, and the eternal battle between intellect and emotion that every single trader must face? His life is a warning that in the grand game of speculation, mastering the market is only the first and perhaps the easiest part of the battle. The true, final, and most dangerous opponent is, and always will be, oneself. Before we continue on this journey, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. To understand the genius of Jesse Livermore, one must first understand the world that created him. He was not born into the privileged echelons of Wall Street, nor was he educated in the hallowed halls of an Ivy League university. His story begins in Acton, Massachusetts in 1877, in a world far removed from the frantic energy of the stock ticker. His was a future that seemed pre-written, a life destined for the grueling, repetitive labor of a farm. For a boy of ordinary mind, this might have been an acceptable fate. But Livermore's mind was anything but ordinary. From his earliest years, he possessed a prodigious, almost unnerving gift for numbers. He was a mathematical prodigy, a boy who could reportedly master 3 years of arithmetic in a single year, his mind consuming complex calculations with an effortless speed that baffled his teachers. His mind was not built for the slow, cyclical rhythms of the seasons. It was built for the rapid, dynamic, and numerical language of the market, even though he did not yet know what a market was. The inevitable collision came at the age of 14. His father, believing his son's education to be complete, pulled him from school to begin a life of farm work. For Livermore, this was not a career path. It was a death sentence for his intellect. In an act of quiet desperation and incredible courage, he conspired with his mother. She gave him $5, a small fortune scraped together from household savings, and with that meager stake, he left his pre-written life behind, boarding a carriage for the bustling metropolis of Boston. It was the first and most important trade of his life. He sold a future of certain drudgery for a future of pure, unknown potential. He arrived in Boston with no connections and no plan, only a sharp mind and a need to survive. He quickly found work in a place that to an outsider looked like a respectable brokerage office. It had a large board covered in stock symbols, chairs for clients, and the rhythmic, authoritative clatter of a ticker tape machine in the corner. But this was no brokerage. It was a bucket shop, and it would become Jesse Livermore's first and most important university. To comprehend Livermore's early genius, it is essential to understand the nature of these establishments. A bucket shop in the late 19th century was, in essence, a financial casino that used the New York Stock Exchange as its roulette wheel. No actual shares were ever bought or sold. When a customer bought a stock, they were simply placing a bet with the house, the bucket shop owner, that the price would go up. When they sold a stock, they were betting that it would go down. The entire operation was a zero-sum game between the customer and the proprietor. The game was, of course, heavily rigged in favor of the house. The shops employed a variety of tactics to ensure their profitability. They offered enormous leverage, allowing customers to control a large position with a tiny amount of capital. This was their primary weapon. A small fractional move against a customer's position would be enough to trigger an instant margin call, wiping out their entire stake, which the house would simply pocket. There was no recourse, no appeal. But for all their predatory practices, the bucket shops offered one unique feature that inadvertently created the perfect training ground for a mind like Livermore's: instantaneous and direct feedback. The price on the big board was the price of the bet. There was no delay, no intermediary, no noise, only the pure, unadulterated movement of the price itself. Livermore's first job was at the very bottom of this ecosystem. He was a board boy. His sole function was to stand by the ticker machine, listen to the prices being called out, and immediately write them in chalk on the massive board for the customers to see. For hours every day, he was not a participant, not an analyst. He was a human conduit for the raw, unfiltered flow of market data. Thousands upon thousands of numbers poured through his mind: Union Pacific, U.S. Steel, American Sugar, each with its own unique rhythm, its own character. He was, without realizing it, absorbing the very heartbeat of the market. It was during this time that he began a secret practice. He started carrying a small notebook, and as he posted the prices on the board, he would also jot them down for himself. He wasn't interested in the news, the fundamentals of the companies, or the opinions of the older men in the room. He was looking for something more elemental: repetition. He began to notice that before a stock made a significant advance or decline, its price would often behave in a specific, recurring way. It would form patterns, sequences of fluctuations that acted as a tell, a signature of its future intent. He wasn't learning a theory from a book. He was discovering the laws of market physics through pure empirical observation. After months of this silent study, he made his first move. He confided in a friend, and together they pooled their few dollars to make a bet on a rise in Burlington stock. Livermore's notebook had told him the pattern was right. He placed the bet and watched the board with an intensity only a boy risking everything can know. The numbers flickered, the price moved, and soon he was proven correct. He had made a profit of $3.12. It was not the money that electrified him, it was the confirmation. The patterns in his notebook were not random. They were real. He had found a crack in the armor of the game. From that moment on, his ascent was meteoric. He continued his work as a board boy by day, but his real work was his private speculation. He developed his system with an almost scientific rigor. He learned that stocks, like people, have distinct characters. Some were volatile and erratic, others were steady and predictable. He learned to differentiate between a stock's normal, healthy fluctuations and the telltale signs that a major, decisive move was imminent. His strategy was simple. When he recognized one of his proven setup patterns, he would bet on it, and bet heavily. His success was astonishing. The boy who had arrived with $5 was now making hundreds, then thousands. By the age of 15, he had made his first $1,000. By his late teens, his net worth had climbed to $10,000, a staggering sum at the time. He quit his job as a board boy to become a full-time speculator. His legend began to grow in the shadowy world of Boston's bucket shops. They gave him a nickname that reflected both his youth and his fearless aggression, the Boy Plunger. But his success came at a cost. The bucket shops were not in the business of creating winners. They were designed to systematically fleece the public. Livermore was no longer just another customer. He was a statistical anomaly, a flaw in their business model. He was beating the house consistently and decisively, and the house began to fight back. At first, they would place restrictions on him, refusing to let him trade in the large sizes he preferred. Then, they demanded he post a much higher margin than other customers, reducing his leverage and his edge. When that failed to stop him, they simply banned him outright. He would walk into a familiar shop only to be told his business was no longer welcome. He became a marked man. To continue his work, he had to resort to subterfuge, using disguises and paying other men to place his bets for him. But his signature trading style was so unique that he would inevitably be discovered. Eventually, he had run out of venues. He had been so successful that he had effectively been barred from the entire Boston underground financial scene. The very environment that had forged his genius was now closed to him. The bucket shops had taught him everything about the language of the tape. They had honed his intuition to a razor's edge and given him a substantial fortune. But in their hostility, they taught him one final, crucial lesson. If you have a winning system, the house will eventually change the rules to stop you from winning. He realized that to continue to grow, to play for the truly monumental stakes he now sought, he had to leave the rigged casino behind. He had to go to the source. He had to go to New York. By the age of 20, having been systematically and unceremoniously banished from the bucket shops of Boston, Jesse Livermore made his inevitable pilgrimage to the financial heart of the world, New York City. He arrived not as a penniless hopeful, but as a young conqueror. According to his own account, his stake was $10,000, a colossal fortune for a man of his age at the turn of the 20th century, equivalent to over $300,000 today. It was a testament to his almost supernatural ability to decipher the cryptic language of the ticker tape. He was confident, flush with cash, and possessed a system that he believed was infallible. He had solved the puzzle of the market, and the New York Stock Exchange, with its immense liquidity and endless opportunity, would be his grand stage. The market, however, is a notoriously brutal teacher, and it was about to deliver the first great humbling lesson of his career. His entry into the big leagues of the NYSE was an immediate and disorienting failure. His system, which had operated with the precision of a finely tuned watch in the bucket shops, suddenly and inexplicably broke down. Trade after trade, what should have been small, quick profits turned into small, quick losses. The erosion of his capital was steady and relentless. For a mind like Livermore's, which thrived on logic and pattern recognition, this was a deeply unsettling experience. The tape was telling him the same stories of supply, demand, and momentum that it always had, but his results were now the polar opposite of what they should have been. The reason for this bewildering failure was not a flaw in his analysis, but a fundamental structural difference in the mechanics of the game he was now playing. It was the problem of the ticker tape delay. In the synthetic world of the bucket shop, the game was direct and absolute. The price displayed on the chalkboard was the price of the transaction. Execution was instantaneous. Livermore's entire methodology was built upon this foundation of immediacy. He was a master of exploiting the smallest, most fleeting of price fluctuations, scalping fractions of a point with a speed and accuracy that no one could match. But the New York Stock Exchange was a physical, analog, and far more complex machine. When a trade was executed in the roaring chaos of the trading pit, a floor runner had to physically carry the record of that transaction to a telegraph operator. The operator then tapped out the stock symbol, quantity, and price in Morse code. This signal traveled over the wires to the thousands of ticker machines clattering away in brokerage offices across the city. By the time the paper tape spooled out with the printed price and Livermore saw it, several crucial minutes had passed. He was, in effect, trading against a ghost. He was making decisions based on a delayed and distorted reality. By the time he saw the tape print a price of, for example, $100 and placed his order to buy, the real price on the floor had already moved on. He was consistently buying higher than his intended entry and selling lower than his intended exit. The microscopic edge upon which his entire system was built was being completely erased by the friction of this time delay. For a high-frequency trader like the young Livermore, it was a fatal flaw. His initial $10,000 stake, which had seemed so vast, was quickly whittled down by this steady stream of baffling losses. He was forced to retreat, his confidence shaken and his capital diminished, to lick his wounds and try to understand why the game had suddenly changed on him. After a period of reflection and a likely return to the bucket shops to rebuild his capital, he came back to New York. He was chastened, but he had adapted. He realized he could no longer scalp for fractions. He had to trade for larger, more substantial moves, swings of several points, not eighths of a point, that would render the ticker delay irrelevant. He began to look for the truly big game, the major market movements driven by the campaigns of the era's great financial titans. And in the spring of 1901, his ever-watchful eye on the tape detected the telltale signs of a colossal move in the making. The stock was the Northern Pacific Railway. With his signature intensity, Livermore observed the behavior of the stock for days. The tape told an unmistakable story. It was being accumulated in enormous quantities. With every small dip, a wave of buying would emerge, absorbing all available shares. The price was climbing with a steady, relentless pressure, and the volume was immense. It was a classic textbook picture of a major accumulation campaign by powerful unseen interests. Livermore's analysis was, as it had been so many times before, 100% correct. What he was witnessing on the tape were the opening salvos of one of the greatest corporate battles of the Gilded Age. He was, unknowingly, watching two of the most powerful financial syndicates on Earth wage a secret war for control of the railroad. On one side stood the formidable E.H. Harriman, a ruthless and brilliant railroad magnate backed by the immense wealth of Kuhn, Loeb and Company and the Rockefeller family. On the other side was the most powerful banker in the world, J.P. Morgan, allied with the great railroad builder James J. Hill. Both syndicates saw the Northern Pacific as the strategic key to controlling all rail traffic across the American Northwest. and both were determined to own it, whatever the cost. Their secret, aggressive buying was the force fueling the powerful uptrend that Livermore had so skillfully identified. Convinced he was on the right side of a historic move, he plunged in, buying as many shares and call options as his rebuilt capital would allow. He was long, and he was absolutely right. The secret war for control burst into the open in early May 1901. As the two sides frantically tried to outbuy each other, they triggered a catastrophic technical condition known as a corner. In their frenzy, they had collectively bought up more shares of Northern Pacific than were actually available for public trading. This created a massive short squeeze. Any trader who had shorted the stock, betting on its price to fall, was now caught in a fatal trap. To close their positions, they were legally obligated to buy back the shares they had borrowed. But there were no shares to be bought at any sane price. The Morgan and Harriman interests had vacuumed them all up. The shorts were at their mercy. The result was a market explosion of unprecedented violence. The price of Northern Pacific stock, which had been trading around $150 just days before, went parabolic. It blasted through $200, then $300. On the floor of the exchange, it hit $700 and was even briefly quoted at an astonishing $1,000 per share. It was a full-blown mania. For Jesse Livermore, who was long, this should have been the crowning achievement of his young career. His paper profits were astronomical. Instead, it became the crucible of his destruction. The extreme, unheard-of volatility threw his own brokerage firm into a state of panic. These were uncharted waters, and they feared that the swings were so violent that their clients, and therefore the firm itself, could be rendered insolvent in an instant. To protect themselves from this existential risk, they did something Livermore had never anticipated. They began to drastically and repeatedly raise their margin requirements in the middle of the trade. One moment, Livermore was a client with a fantastically profitable position. The next, he was a liability whose position threatened the firm's very existence. The margin calls began to pour in, demanding enormous sums of fresh cash to secure his holdings at the new, wildly inflated prices. Livermore, despite being fabulously wealthy on paper, did not have the millions in liquid cash on hand to meet these sudden and exorbitant demands. He was trapped. He was forced by his own broker to liquidate his winning positions, not because his analysis was wrong, not because the trend had changed, but simply to meet the escalating margin requirements. He was shaken out of the trade of a lifetime for a relatively small profit, forced to stand by and watch in agony as the stock continued its historic ascent without him. The psychological blow was immense, and it led him to break the cardinal rules of his own developing philosophy. The panic in Northern Pacific had caused the rest of the market to collapse as terrified investors sold everything to raise cash. Livermore, demoralized and desperate to recoup the fortune he felt had been stolen from him, began to trade on pure emotion. He was revenge trading, trying to force the market to pay him what he was owed. He shorted stocks that had already collapsed. He bought others with no proper setup. His discipline, the very foundation of his genius, completely evaporated in a cloud of frustration and ego. In a matter of weeks, he had lost not only the profit he had salvaged from the Northern Pacific trade, but his entire remaining capital. At the age of 24, the boy plunger, the prodigy of the bucket shops, was officially bankrupt. This first great failure was the most important and formative education of his life. It was here, in the ashes of his first New York fortune, that he was forced to learn the lessons that would become the bedrock of his future: legendary successes. The first lesson was that tape reading, while essential, is not enough. It could tell him what was happening, but it could not tell him the sheer scale of the forces behind the move. He had correctly identified a powerful bull campaign, but had no conception that he was caught in the crossfire of a war between the world's most powerful financiers. The second and most critical lesson was that risk is a multi-dimensional force. He had been 100% correct on the direction of the trade and had still been annihilated. This taught him that a speculator must manage much more than just directional risk. He was a victim of volatility risk, where the price swings were too violent for his capital to withstand, and systemic risk, where his own broker, a component of the system he relied upon, changed the rules of the game to ensure its own survival at his expense. Finally, he learned that capital is not just a stake to be wagered. It is ammunition, it is armor, it is staying power. A profitable position is worthless if you do not have the reserve capital to defend it against the market's unexpected and often irrational convulsions. He realized then that he had to evolve. He could no longer be a simple tape reader, a glorified gambler reacting to the market's every flicker. To survive and one day conquer the New York Stock Exchange, he would have to become a true speculator, a grand strategist who not only analyzed the tape but who also managed capital with iron discipline, understood the macro forces that shaped the battlefield, and above all mastered his own powerful and dangerous emotions. This catastrophic failure was not his end. It was his true beginning. The years following his first bankruptcy in 1901 were a period of forced humility and deep introspection for Jesse Livermore. The market had stripped him not only of his fortune, but also of his youthful arrogance. He was cast out of the game, a prodigy who had flown too close to the sun and had been burned to ashes. But for a mind like Livermore's, failure was not a destination. It was a brutal but effective teacher. He spent this time in the financial wilderness, rebuilding a small stake and, more importantly, re-evaluating the very foundation of his approach. The boy plunger was dead. A new, more calculating and infinitely more dangerous speculator was about to be born from his ashes. His new philosophy was forged in the fire of his past mistakes. He had learned the hard way that a winning system was useless without an unbreakable defense. His new prime directive, the rule that would govern the rest of his career, was capital preservation. He vowed to never again allow any single trade, any single market event, or any single emotional impulse to threaten his entire operation. He also learned the supreme virtue of patience. The market, he now understood, did not offer life-changing opportunities every day or even every month. They were rare, precious alignments of circumstance and psychology. His job was not to trade constantly, but to wait with the stillness of a predator for the perfect moment to strike, preserving both his capital and his mental energy for the decisive battle. Most profoundly, he began to look beyond the flickering numbers on the ticker tape. His 1901 failure had taught him that the tape was merely the surface of the ocean. It showed the waves, but it did not always reveal the deep, powerful currents of the global economy that created them. He began to study the fundamentals of the market in earnest, the flow of money, the state of credit, interest rates, and the balance of international trade. He was no longer just a tape reader. He was becoming a student of the grand macroeconomic game. It was this new, synthesized approach, combining his intuitive genius for tape reading with a disciplined, analytical framework, that he would bring to bear on the Great Panic of 1907. The storm clouds for that panic began to gather more than a year earlier, and thousands of miles away. In April of 1906, a catastrophic earthquake and subsequent fire devastated the city of San Francisco. The disaster was not just a human tragedy, it was a massive, unforeseen shock to the global financial system. To pay out billions in claims, insurance companies, particularly the great firms in London, were forced to liquidate vast holdings of American stocks and bonds to raise cash. This huge wave of selling put a steady, relentless pressure on the New York market. Simultaneously, the Bank of England, seeing its gold reserves being depleted to fund the San Francisco reconstruction, began to raise interest rates to attract capital back to London. This created a global credit crunch. Money became tight. In the financial ecosystem, credit is like oxygen. When it is plentiful and cheap, speculation thrives and bull markets can soar. When it becomes scarce and expensive, the system begins to suffocate. As Livermore watched the tape through 1906 and into 1907, He saw these deep economic problems reflected in the price action. He saw the market struggling to advance on good news and falling sharply on bad news. He saw the great leading stocks of the bull market begin to falter and roll over. He recognized these signs not as a temporary correction, but as the telltale symptoms of large-scale distribution by the smartest and most informed financial interests. The bull market, he concluded, was dying. With this conviction, he began his campaign. But this was not the boy plunger of old making huge, impulsive bets. This was a new, methodical Livermore. He began by initiating small probe positions, shorting a few of the market's former leaders. He was testing his hypothesis, feeling for the market's line of least resistance. If a short position moved against him, he would cover it immediately for a small, disciplined loss. His ego was no longer in the game. A small loss was simply the cost of information. But when a trade moved in his favor, he took it as confirmation from the market itself. He would then press his bet, adding to his short line, building his position like a general committing more troops to a successful advance. He was stalking the bear, moving with a quiet confidence that grew with every piece of confirming evidence the tape provided him. It was a lonely position to hold. The majority of Wall Street and the public remained optimistic, but Livermore had learned to trust his own analysis above all else. The trigger for the final violent collapse came in October of 1907, a failed attempt by a group of speculators, led by a man named F. Augustus Heinze, to corner the stock of the United Copper Company resulted in the failure of the bank that had financed their scheme. The bank's collapse in turn sparked a run on the much larger Knickerbocker Trust Company, the third largest trust in New York, whose president was associated with Heinze. The Knickerbocker, unable to withstand the wave of withdrawals, was forced to close its doors. And then, panic. The failure of a major financial institution sent a shockwave of terror through the public. Depositors, fearing for the safety of their money, began to line up in the thousands outside every trust and bank in the city, demanding their cash. The financial system was on the verge of total collapse. On the floor of the New York Stock Exchange, chaos reigned. Prices were not just falling, they were evaporating. Liquidity vanished. There were no buyers, only a tidal wave of desperate sellers. For Jesse Livermore, sitting calmly in the quiet of his brokerage office, this was not a moment of fear. It was a moment of vindication. This was the violent, chaotic confirmation of the thesis he had been patiently building for over a year. His short positions, built so methodically, were now generating profits at a staggering rate. With every calamitous drop on the ticker tape, his fortune swelled. By the end of the main panic day, October 24th, 1907, he had covered his positions and tallied his profits. He had made, in a single day, his first $1 million fortune. Some accounts placed the figure as high as $3 million. He was no longer just a successful trader. He was a legend. His legend was cemented by an event that occurred at the very peak of the crisis. As the financial system teetered on the brink of apocalypse, the great banker J.P. Morgan, at the request of President Theodore Roosevelt, took personal command. He worked around the clock, locking the nation's top bankers in his library and forcing them to commit their capital to a bailout fund to save the solvent banks and trusts. During this delicate operation, Morgan's team identified one of the major forces adding fuel to the fire: the relentless short selling of the mysterious and powerful speculator, Jesse Livermore. As the story goes, a message was dispatched from the great J.P. Morgan himself to Livermore's office. It was a plea from the King of Wall Street to the Great Bear, a request that he, for the good of the nation, stand down. For the love of God, the message reportedly urged, Morgan asks you to stop selling. Livermore, recognizing the gravity of the situation, complied. He was a speculator, not a vandal. He understood that there was no profit to be made in the total collapse of the system itself. At the height of the panic, he stopped shorting and began to buy, helping to provide the liquidity that put a floor under the market. This act, whether out of patriotism or pure self-interest, made him a figure of immense renown. The boy who had been run out of the bucket shops was now a man who could receive a personal request from J.P. Morgan. He was no longer the boy plunger. He had become the great bear of Wall Street. The triumph of 1907 was the culmination of everything Livermore had learned. It was not simply a repeat of his early intuitive success. It was a synthesis. It combined his innate, almost psychic genius for reading the tape, the what, with the hard-won analytical lessons of his 1901 failure. He now possessed the patience to wait for the perfect setup, the discipline to manage his risk with probing positions, and the intellectual framework to understand the deep macroeconomic currents that were the ultimate drivers of the trend, the why. This event marked his transformation into the complete speculator, a figure who could read both the micro movements of the tape and the macro currents of the global economy, and who now had the discipline to act on his convictions with the cold, calculated precision of a true professional. The aftermath of the 1907 panic transformed Jesse Livermore from a successful speculator into a Wall Street celebrity. He was the great bear, the man who had stared into the abyss of a financial collapse and emerged with a fortune. He purchased a luxury yacht, a private rail car, and maintained opulent residences staffed by a full retinue of servants. He was living the life of a financial king, his every move watched and whispered about in the boardrooms and brokerage offices of New York. But for a mind as restless and brilliant as Livermore's, the comfort of success was a gilded cage. Having conquered the stock market, he sought a new, more volatile and more challenging arena in which to test his genius. He found it in the wild and treacherous world of the commodity markets, and specifically in cotton. The cotton market of the early 20th century was a place of immense opportunity and even greater risk. It was highly leveraged, subject to violent price swings based on weather reports, crop forecasts, and the ever-shifting tides of global demand. For a master tape reader like Livermore, it presented a fascinating new puzzle, a new language to decipher. He threw himself into it with his signature intensity, and for a time his success was nothing short of spectacular. He applied the same principles of tape reading and trend following that had served him so well in stocks, and they worked beautifully. He made several $1 million, earning a reputation as one of the most dominant forces in the cotton pit. He was, for a time, the new Cotton King. But it was here, at the peak of his success and confidence, that he would make the single greatest mistake of his career, a mistake born not of a flaw in his analysis, but of a flaw in his character: hubris. In the world of cotton, there was one man whose reputation was considered unimpeachable. His name was Percy Thomas, a legendary and highly respected trader known by all as the Cotton King. Thomas was not a tape reader like Livermore. He was a deep fundamental expert who knew everything there was to know about the crop, its cycles, its statistics, its very soul. Livermore, for all his self-reliance, held Thomas in high intellectual regard. In one fateful trading campaign, Livermore's own analysis of the tape told him in no uncertain terms that the price of cotton was overextended and due for a major decline. He was bearish, and he began to methodically build a large short position, acting on the clear signals his system was giving him. His position was already showing a handsome profit. But then Percy Thomas sought him out. Thomas, with the unshakable conviction of a master, was profoundly bullish. He presented Livermore with a dizzying array of fundamental arguments and statistics, insisting that the crop was in far worse condition than anyone knew, and that the price was destined to soar. And here, at this critical juncture, Jesse Livermore committed his cardinal sin. He allowed the persuasive personality and immense reputation of another man to overrule his own impartial analysis of the market itself. He let a tip, albeit from the most respected source imaginable, cloud his own judgment. The act was a betrayal of his entire philosophy. He not only abandoned his own correct analysis and covered his profitable short position, but in an act of ego-driven folly, he followed Thomas's lead and went massively long, betting his fortune on another man's opinion. The market, as Livermore's own tape reading had originally predicted, then collapsed. The price of cotton plummeted with a speed and violence that was breathtaking. Trapped on the wrong side of the market in an enormous leveraged position, Livermore's fortune evaporated. The losses were catastrophic, wiping out everything he had made in cotton and then some. This single disastrous decision, born from a moment of intellectual vanity, led directly to his second bankruptcy in 1915. He was over $1 million in debt, a pariah on Wall Street, a king reduced to a pauper. The years that followed were his time in the wilderness. The man who had a private rail car now had to hide from his creditors. The phone in his office, which had once rung with the calls of the most powerful men in finance, was now silent. This period of debt, isolation, and public failure was, by all accounts, the most painful of his life. But it was also the most intellectually productive. With the pressure of daily trading removed, he was left with nothing but time to think. He replayed every trade, every decision, and every mistake of his career, searching for the root cause of his repeated cycles of boom and bust. It was during this dark period of reflection that he began to formally codify his rules. He took the intuitive, hard-won lessons from his 2 decades in the market and for the first time transformed them into a clear, explicit system of principles and laws. This was not the wisdom of a man basking in success. It was the scar tissue of a man who had lost everything by violating his own fundamental truths. He wrote down the very rules that have since become legendary. He reaffirmed the law that a speculator must never argue with the tape. The market's verdict is final, and all personal opinions are worthless in the face of its judgment. He codified the rule to beware of all inside information and tips, no matter the source. He learned the hard way that a man must believe in himself and his own judgment if he expects to make a living at this game. He articulated the principle of never averaging down on a losing position, calling it a cardinal sin. He detailed his strategy of probing positions and only adding to a trade after it has first shown you a profit, confirming your initial judgment. And above all, he focused on the absolute necessity of emotional control, recognizing that the speculator's greatest enemies are not the market's fluctuations, but the timeless human impulses of hope, fear, and greed that reside within. The core philosophical insights that would later be immortalized in Reminiscences of a Stock Operator were all forged in the crucible of this painful exile. He was building an intellectual fortress, a system of rules so robust and so clear that he hoped it would protect him from his own worst instincts. And when the great World War I bull market began to roar, he used these newly codified rules with an almost religious discipline to slowly, methodically, and brilliantly rebuild his fortune, eventually paying back every one of his creditors with interest and re-establishing himself as a major force on Wall Street. Livermore's journey to create his system was solitary, intuitive, and forged through painful, repeated trial and error. But he was not the only genius of his era seeking to find order in the market's apparent chaos. His contemporaries, Richard Wyckoff and William Delbert Gann, approached this same monumental task from different, but no less powerful perspectives. Wyckoff developed a brilliant methodology for tracking the actions of the smart money, giving traders a way to see the invisible hand of accumulation and distribution behind the price movements. Gann, on the other hand, pioneered a revolutionary approach based on the immutable cycles of time, believing that market turning points were mathematically preordained. To explore these structured, systematic approaches to market mastery, we invite you to explore our 2 new dedicated channels. You can find the links in the description below. The decade following the First World War was a period of unprecedented and seemingly endless prosperity in America. It was the Roaring Twenties, an era of jazz, cultural revolution, and above all, a profound and intoxicating economic boom. The proliferation of the automobile, the radio, and other consumer technologies, fueled by mass production and the seductive new instrument of consumer credit, created a wave of optimism that swept the nation. This optimism found its most potent expression in the stock market. For the first time in history, the general public entered the market en masse. It was no longer the exclusive domain of the wealthy elite. It became a national obsession. Stories of chauffeurs, maids, and shoeshine boys making fortunes on stock tips were rampant. The market was seen not as a complex mechanism of risk and value, but as a magical one-way path to guaranteed wealth. This belief was bolstered by the leading economic and political voices of the day. A powerful narrative took hold. The old rules of boom and bust no longer applied. America had entered a new era, a plateau of permanent prosperity. The famous economist Irving Fisher made his now infamous declaration just days before the crash, stating that stock prices had reached what looks like a permanently high plateau. The public, armed with the ability to buy stocks on as little as 10% margin, believed him. They leveraged themselves to the hilt, pouring borrowed money into a market whose valuations had become completely detached from any underlying economic reality. It was a classic speculative bubble, the grandest the world had ever seen. But from his quiet, secluded office, far from the euphoric roar of the trading floor, Jesse Livermore saw a completely different picture. He was now a seasoned veteran, a man who had seen booms and busts, panics and corners. He looked at the market not with the hopeful eyes of the public, but with the cold, diagnostic gaze of a master surgeon. And he saw all the telltale signs of a patient in the final feverish stages of a terminal illness. He saw the parabolic, unsustainable advance of the market averages. He saw the insane valuations of popular stocks. And most importantly, he saw the classic, unmistakable signs of large-scale distribution that he had learned to recognize over 3 decades of intense study. He knew with a certainty that bordered on the absolute that a great reckoning was coming. His methodology for identifying this historic top was the culmination of his life's work, a refined and powerful concept he called the pivotal point. For Livermore, a pivotal point was not just a simple pattern, it was a profound and decisive change in the character of the market. It was the moment that the primary, underlying force that had driven a trend for months or years finally showed undeniable signs of exhaustion and reversal. His analysis began, as always, not with the broad market averages, but with the leading stocks. He knew that the Dow Jones Industrial Average was a lagging indicator, a weighted sum of many different companies. The true health and direction of the market, he believed, were always revealed first in the behavior of the small handful of stocks that had been the undisputed generals of the bull market army. Throughout 1928 and 1929, he watched these leaders, stocks like General Motors, Radio Corporation of America, and U.S. Steel, with the focus of a hawk. As long as they continued to make new highs, the trend was safe. But in the late summer of 1929, he began to see the first cracks in the armor. One by one, these leaders would surge to a new high, and then instead of consolidating and advancing further, they would falter and decline sharply on heavy volume. This was the first warning sign. The smartest money, the insiders and great pools that had engineered the boom, were now quietly and skillfully selling their shares to the euphoric public. With these initial warnings in hand, Livermore began his campaign. This was not the impulsive boy plunger of his youth. This was the master strategist. He did not immediately place a massive bet that the market would crash. To do so would have been reckless, an act of ego. Instead, he began a methodical and patient probing campaign. He would identify a leading stock that was showing clear signs of weakness and initiate a small scout or probing short position. This was a low-risk reconnaissance mission. He was sending a small troop into enemy territory to test its strength. If the market rallied and his probe was stopped out for a small loss, he accepted it without emotion. The loss was simply the price of information. The market was telling him, not yet. But if his probe showed a profit, if the stock drifted lower or failed to rally with the rest of the market, he took it as a critical piece of confirmation. The market was telling him his thesis was correct. He would then add to his position, building his line of shorts with the patience and precision of a master bricklayer. He added to his shorts only when the market itself proved he was right, using the tape as his ultimate guide. This methodology required immense psychological fortitude. To be a lone bear in the final, most euphoric stage of the greatest bull market in history was an act of supreme intellectual and emotional discipline. Every small rally, every optimistic headline, every story of a friend making a fortune would have tested his conviction to its very core. But he had learned from his devastating failure in the cotton market. He would never again trust another man's opinion over the clear, unbiased verdict of the tape. The true, decisive, pivotal point arrived in early September 1929. The market made its final all-time high and then began to roll over with a new and violent intensity. It broke below a key support level that had held for months. For Livermore, this was the signal he had been waiting for. This was no longer a probe. This was the confirmation of a major trend reversal. He now began to short the market aggressively, selling not just the weak leaders but the entire market, using the full weight of his capital to press his advantage. The end came in October. The first wave of panic hit on Black Thursday, October 24th. The market opened in a storm of selling. But in the middle of the day, a group of powerful Wall Street bankers, led by Richard Whitney of the House of Morgan, strode onto the floor of the exchange and began to place large, ostentatious buy orders in the leading stocks. It was a calculated display of confidence designed to stop the panic. And for a short time it worked. The market rallied sharply off its lows. The public was reassured. But Livermore was not fooled. He recognized this as an artificial rally, a technically perfect opportunity to add to his short positions at more favorable prices. He sold into the bankers' rally, knowing that no small group of men could hold back the tide that was now turning. The final catastrophic collapse began on Black Monday, October 28th, and culminated on Black Tuesday, October 29th. This was the deluge. The wave of selling was so immense that the ticker tape machines fell hours behind the real-time action on the floor. An air of absolute terror gripped Wall Street. Fortunes that had taken a decade to build were being vaporized in a matter of hours. Stories of ruined investors leaping from windows began to circulate. It was the end of an era. But inside his private, custom-built brokerage office, there was no panic. There was only the quiet, rhythmic clatter of his personal ticker tape. Surrounded by his chalkboards, he was not a participant in the chaos. He was its detached, analytical observer. He was a general in his command bunker watching his perfectly executed battle plan unfold. With every catastrophic downward tick of the tape, with every point the market plunged, his net worth soared. He had positioned himself on the right side of history, and now he was reaping the rewards. The story of that evening has become legend. He returned home to his family, who were gathered in a state of somber dread. They had heard the terrifying news of the crash, the stories of ruin and suicide, and they feared the worst. Seeing the grim look on his face, they assumed he, too, had been destroyed. After a long, heavy silence, his wife finally summoned the courage to ask, "Are we ruined?" Livermore looked at his family and calmly replied that no, they were not ruined. He told them that he had had the best trading day of his life. He was short the market, and his net worth now stood at over $100 million. This was the pinnacle of his mastery, the single greatest speculative trade in history. It was not an act of luck, nor was it a reckless gamble. It was the flawless execution of a perfectly honed methodology, the grand synthesis of every lesson he had ever learned. His innate tape reading ability, forged in the bucket shops, allowed him to see the first signs of distribution in the leading stocks. The brutal lessons in risk management from his 1901 bankruptcy gave him the discipline to use a probing campaign, protecting his capital until the final decisive moment. His macro perspective, learned during the 1907 panic, gave him the conviction to hold his bearish thesis against the tide of public euphoria. And the profound importance of psychological discipline, seared into his soul by his 1915 failure in the cotton market, gave him the strength to ignore the tips, the noise, and the new era narrative, and to trust only his own work and the final verdict of the market. The 1929 crash was the moment all the disparate parts of his genius, the intuition, the analysis, the discipline, came together in perfect, devastating harmony. He was the undisputed king of Wall Street. The aftermath of the 1929 crash placed Jesse Livermore on a precarious throne. He was the undisputed king of Wall Street, a financial titan whose net worth exceeded that of all but a handful of men in America. Yet it was a lonely and treacherous reign. In a nation reeling from the Great Depression, he was not seen as a brilliant analyst who had correctly diagnosed a speculative illness. He was cast as a villain, a great predator who had feasted on the carcass of a nation's prosperity. The public animosity was immense. He received a flood of anonymous letters, many of them death threats, blaming him for the collective ruin. This psychological burden, the weight of being simultaneously a legend in his field and a pariah to the world, was a corrosive force that began to eat away at the foundations of his legendary self-confidence. There was also a deeper, more philosophical problem lurking beneath the surface of his success. For his entire life, Jesse Livermore had been a student and master of a very specific game: the volatile, largely unregulated, and highly speculative American stock market. In 1929, he had won that game in the most decisive and spectacular fashion imaginable. He had reached the summit, achieving a level of success that could never be replicated. But after such a climactic victory, a dangerous question begins to haunt the mind of a conqueror. What comes next? For a man whose identity and self-worth were so inextricably linked to the thrill of the intellectual battle against the market, the quiet of the mountaintop was a disorienting and dangerous place. The absence of a new, greater challenge may have been the first subtle crack in the armor of his iron-willed discipline. While Livermore grappled with these internal pressures, the world he had so thoroughly mastered was beginning to fundamentally change around him. The Great Depression sparked a level of public outrage against Wall Street that forced the hand of the government. Under President Franklin D. Roosevelt's New Deal, a series of sweeping financial reforms were enacted, designed to tame the unruly beast of speculation and prevent such a catastrophe from ever happening again. The centerpiece of this revolution was the creation of the Securities and Exchange Commission, SEC, in 1934. For Livermore, the establishment of the SEC was not just a new set of rules. It was a fundamental rewriting of the laws of physics in his universe. The new regulations systematically dismantled the very market environment in which his genius had flourished. The great speculative pools, syndicates of powerful operators who would combine their capital to manipulate a stock's price, were outlawed. While Livermore was rarely a pool operator himself, he was a master at identifying their campaigns on the ticker tape and riding their waves. That part of the game was now over. New rules governing short selling, such as the uptick rule, were introduced, adding significant friction to the bearish raids he was famous for. Stricter regulations on insider information, corporate disclosures, and the activities of specialists fundamentally altered the flow of information. The tape, in his view, became a less reliable guide, its pure signal now muddied by a host of new artificial constraints. Crucially, the era of extreme leverage, with its low margin requirements that had allowed for spectacular gains and losses, was brought to a decisive end. The market that emerged from these reforms was a different entity. It was slower, more regulated, and less prone to the clean, high-velocity swings upon which Livermore's entire methodology was built. The patterns he had spent 40 years memorizing were becoming less reliable because the underlying structure of the game had been altered. But the old master, now in his late 50s, either could not or would not change with it. He continued to hunt for the familiar predators of his youth in a forest that had been tamed and fenced. As this external professional world shifted beneath his feet, his internal world began to collapse. The 1930s were a period of immense personal turmoil. The pressures of his fame and his declining fortunes strained his family life to the breaking point. He endured a difficult marriage, his wife's struggles with alcoholism, and a traumatic incident where she shot their son, Jesse Jr., though not fatally. He became increasingly isolated, a lonely king in his opulent office, watching a market he no longer fully understood. He was plagued by what we would now recognize as severe clinical depression, a psychological darkness that began to methodically dismantle the very qualities that had defined his genius: his patience, his discipline, his emotional control, and his supreme self-confidence. The breakdown of his psychological equilibrium led directly and inevitably to the breakdown of his trading discipline. The final disastrous trades that culminated in his third bankruptcy in 1934 are a tragic case study in a master systematically violating every one of his own sacred rules. The man who constantly preached about cutting losses now began to average down on losing positions, convinced that his original judgment had to be right and the market was simply being irrational. The man who preached that hope is the speculator's greatest enemy, now held on to these losing trades for months, hoping for a reversal that never came. The man who taught that one must never risk too much on a single idea now took on oversized, reckless positions, violating his own ironclad laws of capital preservation. He was no longer the cold, detached surgeon of 1929. In a tragic regression, he had become the emotional, desperate gambler of his earliest failures, trying to force the market to bend to his will. The market, as always, refused. In 1934, Jesse Livermore, the man who just 5 years earlier had a net worth of $100 million, declared bankruptcy for the third and final time. This was the end of his public life as a great speculator. The following years were a somber coda. He was a man out of time, his fortune gone, the market he knew gone, and his legendary psychological resilience shattered. The final act of his life played out on November 28, 1940. The evening before, he was at the fashionable Stork Club with his wife and a friend. When a photographer approached to take their picture, Livermore reportedly demurred, stating cryptically that he was going on a long trip tomorrow. The following day, he had lunch at the bar of the Sherry Netherland Hotel, a grand establishment on Fifth Avenue. He sat for some time, making notes in his small, leather-bound pocketbook. Around 4:30 p.m., he ordered and drank 2 old-fashioned cocktails. A few minutes later, he walked out of the bar and into a small, secluded cloakroom near the hotel's main entrance. His body was discovered shortly thereafter by an attendant. He was slumped on a stool, a .32 caliber Colt automatic pistol lying at his feet. He had died from a single, self-inflicted gunshot wound to the head. The official investigation was swift. Based on the position of the body, the location of the wound, and the absence of any signs of a struggle, the police immediately concluded it was a case of suicide. The medical examiner concurred, deciding that an autopsy was unnecessary, a common practice in such obvious cases at the time. The most powerful piece of evidence was found in his pocket. The notebook he had been writing in at the bar contained a meticulously written 8-page suicide note addressed to his wife, Harriet, whom he called Nina. While the full text was never publicly released, the police read excerpts to the press. The note was filled with phrases of profound despair. "Things have been bad with me. I'm a failure." And the line that appeared repeatedly, "This is the only way out." Over the years, a few myths and conspiracy theories have arisen, suggesting he was murdered by Wall Street enemies or was the victim of his Black Widow wife. But the historical record is clear and overwhelming. The physical evidence, the detailed suicide note, his documented history of depression, and his recent financial ruin all point to the same tragic conclusion. The great Jesse Livermore, the man who had faced down the most powerful financial forces in the world, had finally been defeated by the one opponent he could never fully master, himself. The note's most haunting line is perhaps its most revealing. "I am tired of fighting." For Livermore, the market, and indeed life itself, was a fight. It was a great and glorious intellectual battle, a puzzle to be solved, an opponent to be outwitted. When his psychological state deteriorated to the point where he no longer had the strength or the will to continue that fight, His life, in his own eyes, had lost its meaning. His story is the ultimate cautionary tale. It is the definitive lesson that the market is a marathon, not a sprint, and it demands not just intellectual brilliance, but relentless psychological endurance. The very traits that had been the engine of his genius became the instruments of his destruction. His supreme courage to take massive risks, his single-minded obsession with the game, and his godlike self-confidence were his greatest assets when anchored by iron discipline. But when that anchor was lost to the storms of personal tragedy and a changing world, his courage became recklessness, his obsession became a prison, and his self-confidence curdled into a tragic, blinding hubris. He proved, in the most final way possible, that the most sophisticated trading system in the world is utterly worthless if the mind operating it is not in a state of unbreakable equilibrium. His life is the final, irrefutable proof of his own greatest lesson. The real battle is never against the market. It is against oneself. The life of Jesse Livermore, when viewed in its entirety, is a story of such towering achievement and catastrophic failure that it ceases to be a simple biography. It becomes a parable, the great and enduring myth of the modern financial markets. He is the Icarus of Wall Street, a figure of profound and tragic genius. But unlike the Icarus of Greek legend, who was merely given wings and a set of rules, Livermore forged his own. Through decades of obsessive study, painful failure, and unparalleled success, he built a system of market speculation so powerful and so insightful that it allowed him to soar to heights no one had ever reached before. He wrote his own rules for navigating the treacherous currents of the market, rules born from the scar tissue of his losses and the brilliance of his victories. And yet, like Icarus, he was ultimately destroyed not by a flaw in his creation, but by a failure to adhere to its fundamental laws. He was burned by the very sun he had learned to navigate, a victim of the same gravitational forces of human emotion that he had so expertly identified in others, but could never fully conquer in himself. His legacy, therefore, is not the $100 million fortune he made and lost, but the priceless and timeless lessons embedded in the arc of his dramatic life. His journey is a complete education in the art and science of speculation, a masterclass taught through the chapters of his own experience. From his beginnings in the bucket shops, he taught us the primacy of price. He learned to listen to the ticker tape as a pure, unfiltered signal, a direct expression of supply and demand, unclouded by news, opinion, or hope. The tape, he proved, was the final arbiter of truth, and a speculator's first and most important job was simply to listen to it and obey. From his first catastrophic failure in the northern Pacific corner of 1901, he taught us about the multidimensional nature of risk. He learned the brutal lesson that being correct on the market's direction is a worthless victory if you are destroyed by volatility, a change in margin rules, or a simple lack of staying power. He demonstrated that true risk management is not just about placing a stop-loss. It is a holistic defense against the myriad seen and unseen dangers of the market environment. From his triumphant comeback in the panic of 1907, he taught us the power of synthesis. His victory was not just an act of intuition. It was the result of combining his innate genius for tape reading with a new, hard-won understanding of macroeconomic forces and iron-willed capital preservation. He showed that the greatest speculators are not just tape readers or economists. They are hybrid thinkers who can see both the waves on the surface and the deep currents flowing beneath. From his painful years in the wilderness and his second bankruptcy in the cotton market, he taught us the absolute necessity of a codified, personal system. It was in the depths of his failure that he transformed his intuitive knowledge into a set of unbreakable rules, a written constitution designed to protect him from his own worst instincts. He proved that the lessons learned in the heat of the market are fleeting, unless they are forged into the cold, hard steel of a disciplined methodology. From his crowning achievement in the 1929 crash, he demonstrated the pinnacle of professional execution. That single legendary trade was the culmination of his life's work. It was the moment his intuitive tape reading, his patient risk management, his broad macro perspective, and his detached psychological discipline all converged in a single, flawless campaign. It stands as the ultimate testament to what is possible when a brilliant mind operates in perfect harmony with a proven system. And finally, from his tragic decline and fall, he gave us his most profound and enduring lesson: the supremacy of psychology. His final years proved that all the knowledge, all the rules, and all the genius in the world are rendered utterly worthless if the operator loses their psychological equilibrium. The market is a great and impartial mirror. It does not create flaws in a person, but it will reflect and mercilessly amplify any that are already there. It will prey on ego, feed on fear, exploit hope, and punish greed. Livermore's final descent showed that the same traits that fueled his genius, his courage, his self-confidence, his single-minded obsession, became fatal poisons when they were untethered from the anchor of discipline. This is the ultimate legacy of Jesse Livermore. He stands as an eternal reminder that the game of speculation is not played on a computer screen or on the floor of an exchange. The real game, the final game, is always played on the 6-inch battlefield between one's own ears. His story proves that in the quest for market mastery, knowing what to do is only the beginning. The true challenge, the lifelong struggle, is to consistently do what you know you should do in the face of the powerful emotional currents that constantly threaten to pull you off course. He is the ghost in the machine of Wall Street, the cautionary tale whispered in every boom, and the voice of reason heard in every bust. The story of Jesse Livermore is the greatest parable of Wall Street, filled with genius, drama, and tragedy. While his life ended sadly, his wisdom, his rules, and the very essence of his psychological journey were immortalized in a single book that forever changed the world of trading. This entire journey, with all its psychological depth, is masterfully chronicled in Edwin Lefebvre's Reminiscences of a Stock Operator, which is presented as a fictionalized biography of Livermore. It is arguably the most important book ever written on trading, and its central theme is the brutal but necessary education in managing risk. For those who are committed to a deeper, more methodical study of these principles, we highly recommend the edition that features a unique, detailed, chapter-by-chapter analysis by Max Davidson, an interpretation specifically designed to translate this century-old wisdom for the modern reader. A link to this essential edition has been provided for you in the description below.